Good afternoon. I hope everyone's had a good day here. I certainly have. We've met lots of interesting people. And as we wind down, our presentation will take about 20 minutes. My name is Patrick Hayes. I'm a former stockbroker and a founding partner of Missold Investments, a fully regulated claims management company. We're here to talk on the subject of financial redress or compensation for clients who may have been missold shares, bonds, or a pension product. We'll have a short question and answer session at the end of the presentation, but I do invite you to drop by stand 88. We'll be around for about half an hour after the presentation if you have any questions that relate to your particular circumstances. Obviously, each client's case is different and unique and need consideration and assessment on their own merits. So some background about myself. I entered the stock market in late 87, shortly after Big Bang deregulated the London Stock Exchange. Some of you may remember that. I became a registered representative of the London Stock Exchange the following spring, and since then have followed a career in smaller companies as a private client broker, specialising particularly in small cap stock. Of course, in those days there was no AIM market, there was the rather aimless USM or unlisted securities market, so things have changed somewhat. There were no nomads in those days as we know them today, but a member firm of the London Stock Exchange would put its name and reputation to a new issue and be responsible for the issuing of a prospectus. So certainly there are similarities with how things work today, and we had our share of corporate fraud. Some of you may remember the instances on the screen there. The majority of historic mis-selling that took place was by specialist small company brokers who thrived in this very lightly regulated environment. And we name a few of those brokers here. When the Securities Association took over regulation from what was called the PIA in the early 90s, there were a number of significant changes in the regulatory arena. Broadly, the Know Your Client rules, those designed to identify the appetite for risk and the appropriate application of varying degrees of risk according to individual client circumstances, were improved. Chinese walls were tightened in the wake of the Leeson's Bearing affair, but there were two areas of the regulators singularly failed to act upon. One was the low capital adequacy requirements for penny share or licensed dealers, as they were known, which encouraged a number of these firms to mushroom. And secondly, the markup applied when these brokers were dealing as principal. Briefly, this entailed a huge discount for that broker buying in size from an institutional investor and a purchase price for the broker's own book, which was demonstrably lower than the ultimate price for the client, or the current market price. So this in turn led to huge margins for the brokers, and those brokers had huge client bases in those days to place the shares with, and margins of 40 or 50% for the broker per transaction were not uncommon. So you fast forward 10 years and several smaller company brokers failed. Between inception in 92 and 2000, just in that short period way back, the FSCS had already paid out millions of pounds in compensation. So the solution our company provides is one of research, investigation and advice on pursuing a claim for mis-selling. That is applying what we already know about the way these firms and stockbrokers handle their affairs, consulting the appropriate statements from regulatory bodies, such as the FCA, and consolidating all of that information with the experience of each claimant on a case-by-case basis. So, briefly, there are different routes for redress. From the firm itself, if the firm is still trading, the Financial Ombudsman Service, you may have heard of the FOS, and that's where the firm in question sees no validity to a complaint. They won't settle the claim. Where do we go? We go to the FOS. Next is the FSCS, of course, the Financial Services Compensation Scheme, which applies where the company is out of business. It's in default, it's in liquidation. And the amount of money that this body has paid out between 2001 and 2011, the financial year 2011-2012, is an average of £2.6 billion per year. So it's been repaid to investors. Where negligence can be proven against directors of a company for mis-selling and the firm in question is not FCA regulated, we can look at taking client cases to a specialist litigation solicitor. There are currently a number of class action cases being brought for mis-selling in the small cap market. So we hope to be able to advise you on the considered option for each individual case. Contract notes for your trades, if not available, are not always necessary. And we can, where appropriate, apply for those on your behalf from the liquidators of the firm in question. So by and large, I've been talking about equity investments made on an advisory basis, determining the potential for success, establishing the most appropriate claims route, and packaging, presenting, and managing the claims. So here we have the options of redress. We will do the heavy lifting for you. If you feel you have a claim, come and see us please on Stand 88. Do find us online, or if you're looking at this on playback, you can click a link, I think possibly embedded there. We've been talking mostly about shares and smaller companies, but a noticeable area of mis-selling in recent years has been that of pension assets, in SIPs, in SASs, and in annuities. And here to talk about that in more detail is my colleague, Peter Faulkner. Thank you, Peter.
Good afternoon. My name is Peter Faulkner, as it says up there. I've been in financial services since 1994, through to the year 2000. Mortgage and insurance brokerage, which I still own, running FCA regulated since 1999. Got involved in property brokerage for several years, and my life before that was in lecturing and academe, which puts me in a good position for rigorous research and development and analysis of what's been happening to people's investments. Now, why has all this come about? You've heard about claims such as PPI and various other claims that have come through. Well, many banks and building societies, as well as IFAs and financial advisor firms, have failed many clients. It doesn't mean to say they've been all bad, but about 15% in the market has been not good and has resulted in clients being failed. But even the major banks, the big high street banks, have found that they've got themselves into a position where they've misadvised the clients. The reasons are fairly obvious. I've put up on there: advisor incentives, commission driven, hiding fees and charges to ease the sale, not declaring those, poor compliance oversight, higher risk products where they've said to clients who need to be cautious or moderately cautious in their investments, and have said, yes, we can do that for you, the risk level is not that high, but in reality have put the funds into very high risk investments, or a high proportion of funds into a high risk investment. One of the reasons for doing that is they get more commissions and more fees. Lower quality training and supervision of advisors who are commission driven, deliberately maximising their own returns. Now, banks, building societies, investment houses and insurance providers, as well as trustees, are all setting aside large sums of money because of claims that are expected to come down through the pipeline. Some major high street banks are addressing this in-house, employing major firms to get in touch with their clients to review what has been sold to them over the time. There's been a huge increase in the Financial Ombudsman Service and the Financial Compensation Scheme levies, which are paid and charged to the financial advice firms, and that is necessary to build up millions of pounds ready to pay out in compensation. There is a legal obligation for the advisor and the provider could be a major insurance company, to consider the personal circumstances. They need to be able to show that they have taken into account the situation of the client, to identify appropriate levels of risk. The capacity for loss needs to be explained to the client, advise about those risks, document everything including the client's situation and the ATR, which refers to the attitude to risk, provide evidence of research, Explain the impact of fees and illustrations. Produce detailed reasons why letters and ensure that the investment chosen matches the client's level of risk. It says, thank you for your interest. Any Q&As, come and chat to us at stand 88. Any questions? Yes. Yeah.
First of all, who does the general manager trust and not trust? And secondly, what information should he or she divulge? Not divulge, for them to do what they say they're going to do.
Well,
Great question.
good
You need
question.
to repeat the question because
Yeah.
they may not have heard that. So the very good question there was really how does the man in the street choose their claims management company or their route to redress? You know, right? You get calls. Can we help you?
Just give us your bank details
Ah, right. Yeah.
No.
and we can find out what's been sold and unsold.
Exactly that. The short answer is obviously to look at the regulation of that company. Any company offering a claims management service needs to be regulated by the Ministry of Justice, as we are. So that's the first thing to check. I would also guard against calls from overseas, calls from withheld numbers. That's sort of common sense. But in terms of a commercial decision, I would just say it would be the same as when you walk into a bank or building society looking to get a mortgage or whatever else, you need to compare the options available to you.
I would say, do some due diligence, look at the person and the company that's offering the service, and really avoid anybody who's looking for money up front. So we provide a service where we do all the advice and recommendations without any charge to work out what's the best route, if there is a claim or a potential claim, and if there is, what is the best avenue, what is the best route to go through, and that the company they're going to deal with is transparent and explains everything along the way as to what they do. We operate on a system of no win, no fee, but then when we get to a point where we say, yes, you have been missold and you are likely to get a positive result on a claim, we will help to package and administer that claim and see that through. And yes, there are fees at that stage. Typically, they would be 25% of the claim amount.
That will be at that time once you've gone ahead and seen
Yeah. Yes. And at no point is that is the client charged direct.
So that's probably the best thing to take away from that very good question, which is do not pay a fee up front. If we've actually been asked to look at victims of fraud who have lost money, but have then been called by a company seeking to take 495 from them on their credit card or whatever, and again, it's a problem, but it's a no-no. Seek out a no-win, no-fee claims manager, such as ourselves, that you can go and see physically and talk to if you need to.
There are also many occasions where a person feels that they've lost money and actually feel it's partly their own fault and don't think they could got any redress and feel that they can't get the money back. But in reality,
Very common.
in many cases, they can get the money back, and there are ways to approach that.
Time barring, that's again a very good question. Depending on the rather complicated different area of financial product, whether it's an investment bond, a share, an ISA, a mortgage, a pension, there are different rules. But in general, it is 6 years from the date of the transaction, or within 3 years of become knowingly aware. It's a very interesting phrase, knowingly aware. Clients may not be aware that a company is in default or has been mis-selling. They may read about it online, but 6 or 3 years is a good example for that. Thank you. Any other questions? Thank you so much for attending.
Right, question?
Question, Stuart. 2.6 billion, and that was that's an FSCS figure, to investors between 2001 and 2011-2012. I'm not quite sure when the financial year ends for the FSCS, but it works out at an average of 2.6 billion per year just in that time. And the reason we took those 10 years was in our experience, that was the most active time for the smaller company brokers of being in default. So it was when claims started to come up. So that's the calculation. Good stuff. Thank you.
Thank you for
Good
your
stuff.
time.
Thank you, Peter.
Yeah.